I'm Erik Schatzker, and welcome to Bloomberg's Front Row. Today, I'm talking to Sarah Ketterer. She oversees $47 billion as CEO of Causeway Capital in Los Angeles. Sarah is a lifelong value investor, but in a world of limitless central bank liquidity and the richest PE ratios in decades, she's had to redefine the discipline.
We're not value investors, we're valuation investors. Valuation is at the heart of everything we do. So if valuation becomes disconnected or de-emphasized, less important because momentum continues to be the only game in town, that would be tough.
Sarah is still finding plenty to do. We discuss what she's buying and selling now, why government bailouts are distorting markets, Causeway's bet on quants, the lure of active ETFs. Here's my conversation with Sarah Ketterer. Sarah, you're a value investor in global equities. Until recently, the stock market was a hostile place for value investors. Value hell, you might say. Tell me about that.
As interest rates globally have fallen so precipitously leading up to the pandemic, and then with the necessity of massive money stimulus, they fell even further. And when interest rates are negligible, near zero or zero, in some parts of the world negative, that means investors are willing to buy long duration assets. They're willing to pay more for growth. They're not necessarily concerned about near-term earnings or cash flow. And that meant that market emphasis went to growth stocks and left value stocks in the dust. And of course, that's the time when we as value managers get really excited, because then we can accumulate more of what we think are great companies at extraordinary bargain prices.
I'd like to know, were there lessons for you in that experience? The pain, for example, of losing clients who didn't have the patience to hang on, and of course, assets with them.
Oh, many lessons, Erik. For one, I learned that human nature and human behavior hasn't really changed in the 30 years I've been in the asset management industry. And I guess it's just a ray of optimism I've had that perhaps people would be a little bit more patient. But it's so extraordinarily difficult, especially with pension fund assets, and those are predominantly our clients at Causeway. They're large institutions looking after huge amounts of retirement money, and those staff members are doing the best they can. So are their consultants to ensure they are allocated properly. But it does look to so many as if we're in a period of sort of endless quantitative easing, monetary stimulus, rates falling, and I can understand the concern about interest rates and about valuation.
And if there's one thing that you found successful in persuading a squirrely client not to pull out, what was it?
We talked to them about prior cycles, going way back, as far back as they want, the 70s, 80s, 90s. But the more recent cycles, I think, resonate with them. We talk about the global financial crisis in 2008 and early 2009, and how it was so important to use the latter part of 2008 and early 2009 to position a portfolio in recovery stocks, in the stocks that are of companies sensitive to the economic environment, or what we call cyclicals. And those cyclical stocks come roaring back. And they did that in the global financial crisis, the materials stocks, the industrials, consumer discretionary, energy, financials, all those that were bludgeoned in 2020, absolutely awful, reaching a nadir in late March of 2020, and then not really going anywhere until we got good vaccine news in November of last year. So we explained to them that these are the stocks that perpetually, every time we have a massive downturn, recession, and subsequent anticipation of recovery, these are the stocks that do the best. And many clients got the message, and I appreciate our team. We spent every waking moment finding ways to explain it. And the fact that many listened was great for clients because they made a fortune, absolutely huge returns off the bottom of the market last year.
The pandemic was an enormous buying opportunity for nimble investors. How did you respond? What did you buy?
Well, first, we responded in a combination of horror and glee, because these big market dislocations often lead to a period of significant value outperformance. So we knew our day had arrived. The question was what to do about it. And all of our stocks fell very dramatically by March 23rd, when global markets reached a bottom. But what we did starting in February of last year was look to trade up. This is a similar strategy we employed in the global financial crisis. Let's take our battered value stocks and see if we can find equally undervalued complements, similar companies, but perhaps even better management or better global positioning, and buy those. And then this crisis, one of my colleagues termed it the global financial crisis, but for transport, for airlines, aerospace, anything to do with aviation, anything to do with lodging, hospitality, et cetera, tourism, destroyed. So we bought we think the world's best aerospace company in Airbus. And we haven't been able to buy that stock in at least a decade. It was too expensive. But investors absolutely abandon it. And other aerospace giants of that nature, not to mention great software companies in the airline and hotel booking area. Software has been a little hard to get access to as a value manager because they often trade, especially these software as a service companies, at multiples of sales and sometimes with very little in the way of earnings. But if software company in travel and tourism, no one wanted them. So we now have our global clients own Booking Holdings, which is a fantastic business. They have Sabre in the U.S., and then our international clients own Amadeus. So again, we just looked longingly at those stocks for years, and this crisis, this pandemic, as horrible as it was, brought some amazing companies to us as value managers, and those stocks will continue. Or Walt Disney is another example in the U.S. market. We believe they'll continue to pay off for years and years ahead, consistent with how value tends to respond coming out of a crisis. In this case, it's not just undervaluation, but these companies have the extra accelerant of the fact that they're post-pandemic beneficiaries.
And Sarah, what are you positioning into now? Because there has been an incredible reflation since March 23rd.
I'll give you one example. We nursed and coddled in client portfolios a fantastic company, Volkswagen, but it went through a crisis in late 2015 with Dieselgate. We doubled positions, and our head of industrials worked very hard with the company management, because that's what we do as value managers. That's modern value management, is working alongside the managements of the companies to hold them accountable. And VW not just is cyclical. I mean, imagine what happened during the pandemic. Auto sales grinding to a halt, and the companies couldn't get their labor engaged. But the stock, emblematic of what's happened with cyclical stocks in these months since November of last year, has rallied incredibly hard. It didn't really start until well after the first quarter. Well, let's say after February. In January, the stock was 140 euros a share, and now it got up as high as 235. And the reason I'm giving you the details on Volkswagen is you need to understand that's a 5-year annualized return of 15%, which for a European stock is fantastic, especially in a fairly distributed business like automotive. But we took profit and we reinvested those proceeds into more defensive areas. When a cyclical stock delivers the good part of its next 2-year return in a handful of months, or 2 in this case, disciplined value managers like Causeway have to reduce the position. We have to. We have no choice, because we work on a risk-adjusted return basis. So the stock on a risk-adjusted, its return is shrinking and the risk is still there, so the stock is no longer as competitive. And then we can reinvest those sell proceeds into stocks that are more competitive. And this has all happened so quickly. I'm sure clients are really quite astounded. But you can't hold a cyclical stock indefinitely, because the stock's price discounts the recovery. And then the next phase is often not nearly as attractive or as enjoyable. And typically an investor should be out by then. These are not stocks to hold indefinitely.
And so rotating out of a cyclical stock like Volkswagen into what? Into what stocks, into what sectors? What looks attractive now based on the way you see things unfolding in the next 1, 2, 5 years?
Well, adjusted for risk, and we define risk as volatility, the stocks that have buoyed up to the top of our ranking, the highest risk-adjusted return stocks, are generally in the areas that have been left behind in this big cyclical recovery. And you can imagine what they might be. Healthcare is one area, stocks in pharmaceuticals, for example, and many of them European, they trade at 12 or 13 times earnings. Think about, the S&P 500 trades at next year's earnings, about 22 and a half times next year's earnings. That's really cheap. They've got 3 or 4% dividend yields, and they have the capacity to buy back stock, and they have the fantastic pipelines, so more product coming, lots of innovation. So they're one area where we put quite a bit of capital. And another laggard in this recovery period is utilities. And we can have a long argument about whether or not rates are going up and how much, but I want that income. And in a utility that has a low valuation, but also has the prospect of transitioning its carbon emitting side of its business into renewables. In the case of the European utilities, pure renewables businesses, that's a multiple re-rating upward just waiting to happen. So there's so much opportunity there. So these defensive areas, consumer staples would be another, provide stability in the portfolio. They bring down portfolio beta or market sensitivity just at the right time, we think, because there are many storm clouds on the horizon.
The market appears to be undergoing a so-called rotation, right? Value is beating growth consistently for the first time in years. Can it last?
We've redefined value. We had to, because buying cheap stocks has never been and will never be enough. You can get caught into the proverbial value trap. This will take any one of us on the team and make us ashen, just the thought of it, where the stock never re-rates upward. And you have to go to clients and explain why it's still in the portfolio. But what we can do is get companies where valuation is important. And particularly as interest rates rise, whether it's just nominal rates because we see a bit of inflation, or even better as real rates rise, that means the discount rate rises on all stocks. And all the stock is, Erik, is just the present value of all the cash the business can generate into perpetuity, discounted to present. And as the discount rate rises, that stream of cash flow is worth less. So getting more of the income of the stock up front, or that shorter duration, is very useful as rates rise, and that speaks to value stocks. Most of the companies that we follow generate quite a bit of cash flow, or they're on the cusp of doing so, and they do it now. We don't have to wait a decade for cash. It's all about today. You may not be overwhelmed with their sales growth, but that cash is valuable, especially if it gets returned to shareholders in the form of dividends and or buybacks.
Sarah, many investors are thrilled that the Fed has taken such an interventionist role in the recovery. You have concerns, and you've termed one of your concerns the socialization of markets. Tell me more about this.
Erik, it's either the socialization or the nationalization of risk, depending on what mood I'm in. But when I get despondent, I use the word socialization, because really for the last several decades, but it's been exacerbated from the global financial crisis of late 2008. As a populace, we expect our governments, and particularly our central banks, to be there as a bailout mechanism. And perhaps we're taking a cue from Japan, where the Bank of Japan began in 2001, just about the same time that we founded Causeway, roughly 20 years ago, to go about massive monetary stimulus to create a bit of inflation. And it hasn't worked. But all that time, all that money creation, and then think about a central bank after buying all the treasuries and whatever mortgage backs they can find, or whatever else, they go into the stock market, which has happened in Japan. 25% of the top 400 stocks in Japan, their top 10 holdings include the Japanese government. That may sound like an anathema to us in the West. Oh, that'll never happen. But it could. I mean, it depends on to what degree we expect our monetary authorities to continue kind of perpetual quantitative easing, and to what degree they'll ever be satisfied with a level of inflation. It may very well be due to demographics and technological changes. Inflation is going to be defined differently in the future. But we will see. All I know is that as a value manager, we want markets to function freely if we can. We think it's very helpful. It allows us to use valuation tools without worrying about an artificial influence. And if investors are willing to take risk because they think that there will always be policy support, then that's a distortion. And distortions make it a little more difficult if you use valuation and what I'd call a large dose of common sense and financial analysis to make decisions. Policy distortions may create a much more favorable environment for momentum investing, which had been dominating markets right through last November.
As a value investor, you need cycles, right?
We do, and we believe in them.
What if this is the end of cycles?
I would stake my entire reputation on the fact that cycles are indomitable. They can't be ended. We can try, and what will happen is with this nationalization of risk, with this sort of seemingly endless amount of policy support, all that does is postpone the inevitable, which is more sharp corrections. And perhaps that was some of what we saw in the meltdown in markets last March. Very sharp correction, and then a very steep recovery. But that doesn't mean to say we're on a smooth glide path. And that's one of the reasons now why we are positioning our client portfolios in more economically defensive areas. Not only are they undervalued, but we want to take risk off just in case we have some sort of reaction. Could be just because rates rise and markets pull back, or there is some other outcome of what has been, again, an absolutely mind-boggling amount of monetary and fiscal stimulus.
There's a raging debate out there about the risk or not of inflation. What do you think? What do you see?
Almost every company we talk to, Erik, and we interview hundreds of companies throughout the year, and we must. There are either they're portfolio companies or they are companies we're anticipating adding to our client portfolios. They may be competitors or suppliers or customers, but all of them talk about constraints in the supply chain, difficulties with logistics, with transport, stoppages at ports, a real problem on the supply side, and then very, very strong demand. So this, to us, looks like a situation typical of an inflationary environment. Too much money chasing too few goods.
Sarah, I like to think that value is in your blood, right? Your father, John Hotchkiss, founded a value shop, Hotchkiss and Wiley, and you worked there before leaving to start Causeway in 2001. Is value investing the same today as it was then? Is it the very same thing it was when Graham and Dodd wrote Security Analysis, or is it different?
I believe it's different. I miss my dad. I think he would have been absolutely blown away by this era, though, because when he and George Wiley started their firm in 1980, they were looking for undervaluation as their primary criteria. And we just can't do that anymore because, again, there are companies globally, and we invest globally, who simply will allow their share price to stagnate. The corporate governance is so weak that the companies aren't particularly interested, or there's so much structural change happening today. So many companies whose businesses are in transition. I mentioned autos earlier. Just think about what's happening there in the move from internal combustion engines to electric vehicles. But it's prevalent across all our industries. So today's version of value investing is a very careful and calculated process of identifying companies that are well positioned in industries where, if they're in transition, these companies are at the forefront, or they're making a massive change to their own company to ensure they will be at the forefront. And that requires a level of research depth that, I think within the last decade is unprecedented.
doing your jobs as active managers who do bottom-up stock picking, right, has always required a lot of boots on the ground work, looking CEOs in the eye, right, as the proverbial saying goes, or touring facilities at companies all over the world. How have you adapted during the pandemic because you can't travel? And how soon do you think you'll be able to get back on planes and do that boots on the ground work?
Even though travel does take away time, sharing the same airspace, being in the same room physically with the management of the company we either are or will invest in, super helpful. We get a lot of communication via body language. When, depending on the culture, whether it be Asia or Europe or wherever else, that's useful information. It's just useful to walk through a company's office and observe this level of organization. Where do people sit? What sort of space do they occupy? What kind of equipment do they have? And all of that is lost in a pure video environment. So we're expecting the future to be hybrid, not just how we work day to day, but how we interact, both with our clients and with the companies we invest in, where we'll do some video, which will replace the conference call, which is a huge upgrade, but we'll also travel. And we will visit their facilities, and we'll visit their competitors. And that will help us patch in areas of knowledge that this last year and a couple of months has taken away.
Sarah, Causeway stands out from traditional value managers for the size of its investment and, for that matter, commitment to quantitative capabilities. Why have you gone down that road?
We have 11 quant specialists at Causeway, 4 of whom are portfolio managers, and they all have different strengths. Some are focused in on emerging markets, some on international small cap. We've got people involved in getting us screens fundamentally to sift through thousands of stocks each week to look for a criteria that bias stocks already to outperform. So we have this huge research advantage. They help us understand, using alternative data and our own investment technology team, how do we interpret quarterly earnings transcripts with natural language processing, obviously? How do we determine, using credit card data, what retail sales will be? The amount of data that exists today that didn't exist even a decade or two ago is extraordinary, and it's only getting bigger. So I've told clients, I can't get out of bed without my quants, and we can't do anything without them. They're absolutely essential. And in turn, to keep them highly motivated, we fundamentally, as a research team, provide them with a continuous flow of information about the companies they're following and about the markets they cover, so that they're better at what they do. And that synergy, we call that convergence, it's at the heart of Causeway. And I'm convinced that that's where the whole asset management industry is headed, that equity managers will need to be a fusion of fundamental and quant because they're so synergistic.
What does it cost to run a business like yours?
Other than gray hair, the cost is the people. We're in the human capital business, and hiring, training, mentoring, and promoting the most extraordinary individuals, that's the biggest cost. They need to be compensated financially, and then in terms of acknowledgement and recognition and more responsibility. So it's tremendous. And we have, I believe, done a great job in diversifying our team. You think about it, as a global equity manager, what we want opinions that far transcend just a U.S. perspective. So 6 out of the 9 fundamental portfolio managers we have were born and raised outside the United States. And that helps us a lot. We're opening offices in other countries. We have one in Australia. We just opened an office in China this past year, in Shanghai. And we'll hire and attract more and more individuals to work there and feed information back to Los Angeles. So the cost is all about the people. And it's not like you could just hire them and let them go. The constant evaluation and feedback and mentoring tracks, this is forever. In order to create a firm in perpetuity, we've needed to make sure that every single individual in our team, whether they're on the investment side or any of the important sides of Causeway, we've got people, every single person has a backup, and the backup has a backup. And this succession planning has been crucial, because if you think about it, if people are at the absolute heart of what we do, if somebody can't come to work for whatever reason, we need the backup to take over right away. And that's why this planning has been so essential. And that never stops. Sometimes people retire. And then what do you do? So you have to make sure. And that's been part of my job over the last several years, is making sure we have succession in place across every function in the firm.
People are expensive. Are you prepared to pay up for the best portfolio managers, the best analysts, the best quantitative researchers, or are you getting priced out?
Not only are we prepared to pay up, but being an independent and nearly 100% employee-owned firm. We're entirely employee-owned, except for one former employee who sits on our board of managers. And what that does is we control our own destiny. And that's why it's so exciting and so high risk to work for Causeway, and being in a small firm that's nimble, but also at any point in time, people could leave and then it's over. So keeping people engaged and motivated and retaining them through equity participation is essential. We've expanded our partnership to 30 people. So that's 30 out of our roughly 100 employees own a stake in the business.
The name of the game for many in asset management is scale and consolidation. Why do you believe it's better to be independent with $47 billion in assets under management instead of part of a trillion-dollar firm or a multi-trillion-dollar firm with infinite resources and infinite marketing muscle?
Well, are they infinite? I think they're certainly finite, just more distributed. This is all to do with accountability. Our clients know there's nothing between us and their performance. Their performance is paramount. We have nowhere to hide. We can't say, oh, well, we'll just be dormant within our parent company for a while. Our clients hire us because they know that if everything we do is directly connected to their performance. Our livelihoods depend entirely on delivering alpha to clients. There isn't anything about developing scale that necessarily benefits clients. They just want alpha, and they want it as consistently as we can deliver it. And that is a very, very hard goal to achieve. But again, our team gets more seasoned every year. We get better at what we do, and our quantitative tools are more extraordinary than they've ever been. So I'm quite optimistic about the future.
Sarah, two existential threats to active managers have emerged in the past decade or so. ETFs on the one hand, and as a byproduct of that, fee compression on the other. What's your strategy for surviving those threats?
ETFs, we like them. And personally, I have winced at mutual fund taxes and sometimes it just seems unfair. You haven't done any trading, instead you have a tax bill. So there will always be the tax-exempt investor who will like mutual funds. But for the taxables, I can understand the migration to ETFs. And not to mention, as securities, they're tradable, and sometimes they help fill a gap in terms of one's own portfolio allocation. So Causeway would like to be in ETFs. We're just a very slow and gradual in what we do. And as for new vehicles, we get market intelligence. We have an extraordinary business development group run out of Philadelphia. And then we plan and then determine just how we're going to enter either a strategy or a marketplace, and do so the most intelligent way possible. But as for, and that would be an active ETF. Passive is slightly different. And there's nothing wrong with passive management. I have some passive funds personally. The problem I have with passive is it's a direct beneficiary of the tailwinds of all this monetary expansion we've been talking about. And if the era changes, it might be a little tougher for passive. In fact, I'm sure it will be. And meanwhile, with active management, there's always that opportunity to outperform, which does not exist in the passive environment by definition. So passive has a place, but active is where the action is.
So if I'm assuming new strategies, are part of the plan as well. What new funds or new strategies are you starting or have in the works?
We make this very transparent to our clients because they don't want us to dilute our time on what we provide to them. So every new strategy we have is complementary. It has some research synergy with what we're already doing. I'd mentioned earlier, for example, our China research. We've been building up China research, and the reason why we singled out that market is because of its size. It's a couple thousand stocks that are investable, and inefficient pricing abounds. You can see this gets me on the edge of the chair because other markets are quite efficient. News gets identified quickly and priced in, and sometimes anticipated before it even occurs. Whereas in China, there are still many companies that aren't well researched and are misunderstood. And that is a gold mine for the active manager. So we are taking our approach and refining it to make it work in the Chinese market. And I believe in our clients, our institutional clients have been very clear, they like having dedicated China portfolios. They may choose to do more of that as that market matures and becomes more institutional and a bit less retail focused in the future. But I think for us, it makes a lot of sense because we have to understand not only those companies as competitors to many of the firms we invest in our international and global portfolios, but also as a large component of our dedicated emerging market strategy. I mean, when all said and done, China makes up about 40% of emerging markets. That's a lot. That's the single largest weight. So we have to be there. So I'd say that is number one, followed closely by the work we're doing in environmental social governance. And this, in ESG, nothing new for Causeway because we have, from our inception 20 years ago, spent tons of time evaluating companies from a governance perspective. Because if shareholders are mistreated, the investment will be a disaster. Furthermore, polluters or companies that abuse their labor, we've avoided those like the plague. But in the last several years, through the work we've done in environmental social governance, led by my colleague Mo Khan, who's a PhD in our Quant area, we have a scoring system so that we can score and then rate and rank these companies based on ESG and do so uniformly across regions. And that has been huge for us, and integrating that into everything we do and then creating a version of that we can offer to clients that emphasizes ESG more so than we do in a typical integration where we are taking into account valuation and other criteria. So a pure ESG strategy, we think that could be something that will be very appealing to clients, especially those offshore, as they need and want more of that in the future.
Is that something you're going to start or something you're just thinking about?
All of this that I've mentioned is in incubation. So we have portfolios, either paper, in the case of China, funded, but way too soon to offer to clients because we have to invest personally. We have to put our own money at stake in these strategies for some period of time before we'll invite in clients. We want to make sure that we can be committed and explain to clients that it's good enough for us, therefore it's good enough for you.
Sarah, as you look into the future, what looms as the biggest obstacle to success for Causeway? We discussed earlier, Erik, this creeping nationalization or socialization of risk. If we get to a point where central banks, because treasuries have borrowed so much, and I'm not just referring to the US, but with debt to GDP at levels where rising cost of debt service is such that rate rises just can't be tolerated, that just will make it tougher for us because, again, we're not value investors, we're valuation investors. Valuation is at the heart of everything we do. So if valuation becomes disconnected or de-emphasized, less important because momentum continues to be the only game in town, that would be tough. You don't just become a value manager, you almost have to be
born a value manager. My colleagues are some of the most frugal, cheapest people I know. But that's great. It turns out that makes them ideally suited to find what others have discarded. But there has to be a re-rating mechanism. An undervalued stock, the company, through its own management and through its own operational restructuring, has to show improved earnings. But then we need to see the market focus in on that and re-rate it. And in a low to zero rate environment, indefinitely, investors may not care.